Vertiv dropped 11.3%, and everyone is panicking. Yet the lab's proprietary rating sits at 65 out of 100, a solid buy endorsement. Vertiv remains the primary gatekeeper for the Blackwell product cycle, significantly anchoring future cash flow. But the lab score is 65 out of 100. Buy. Here's why the sell-off is wrong. Vertiv sits as a Tier 1 bottleneck in the AI supply chain, the power cooling layer, currently in a rising phase. Vertiv's hardware position is currently a structural liability because their lead times for liquid cooling loops have stretched beyond 50 weeks, creating a physical bottleneck that prevents them from capturing the immediate surge in NVIDIA Blackwell B200 demand. When you look at the thermal design power, or TDP, the maximum amount of heat in watts a chip generates that a cooling system must dissipate. Of a B200 GPU, you are looking at a system that demands over 1,000 watts per package. This is not a standard server room environment. This is a high-density thermal management crisis. Vertiv's Liebert XDU coolant distribution units are engineered to manage heat loads up to 1,360 kilowatts, but the physics of the silicon interface is unforgiving. At this scale, the thermal resistance at the interface between the GPU die and the cold plate must be minimized to near zero levels. If the coolant flow rate fluctuates even by a small percentage, the thermal throttling on the silicon happens in milliseconds. The engineering reality is that Vertiv is competing against the physical limits of fluid dynamics. Their systems use water glycol loops to move heat away from the chips, but the transition from air to liquid cooling in legacy data centers is physically intrusive. You are not just swapping hardware. You are re-engineering the entire facility's heat rejection loop. Compared to Schneider Electric, which focuses on broader electrical distribution, Vertiv has optimized for the direct-to-chip manifold. However, the complexity of these manifolds is their greatest risk. Each unit contains custom-engineered heat rejection loops that must be perfectly sealed. A single defect in a weld or a faulty gasket in the manifold leads to catastrophic liquid leakage onto high-value silicon. In the world of semiconductor infrastructure, reliability is measured in parts per million. If Vertiv's yield on these custom-engineered components drops, the entire data center build-out stalls. The market is currently reacting to an 11.33% decline, and the reason is buried in the supply chain. While Wall Street fixates on the $5.7 billion backlog, they are missing the engineering reality of lead times. You cannot build a 1,360 kilowatts cooling unit without high-grade copper and specialized electrical steel. These are the raw materials that act as the physical anchor for Vertiv's production capacity. When you see the stock price at $317.42, you are seeing the market price in the risk that Vertiv cannot scale its manufacturing footprint as fast as the hyperscalers are scaling their GPU clusters. The competitive moat is built on an installed base of over 3,300 service engineers who hold exclusive diagnostic access to the firmware controlling these cooling units. This is a brilliant strategy for recurring revenue, but it is also a physical constraint. Every new installation requires these technicians to be on-site, effectively capping the rate of deployment. If Vertiv cannot train or deploy these engineers at the same velocity that NVIDIA ships B200 GPUs, the bottleneck shifts from the chip to the rack. The market is finally realizing that the AI infrastructure trade is not just about selling boxes. It is about the physical throughput of a global supply chain. If the cooling hardware cannot move, the Blackwell GPUs sit in crates. Vertiv is currently priced for perfection at a forward PE of 35.9x. But the engineering reality is that their ability to deliver is limited by the physical availability of raw materials and the specialized labor required to install them. The stock's 11.33% drop is the market's way of saying that the backlog is only as good as the ability to manufacture it. Quarterly financials showing modest revenue momentum for Vertiv. By Q4 2026, the dominant force of monetary policy will compress Vertiv's valuation multiple as the normalizing yield spread forces a re-evaluation of high-growth industrial assets. We are currently seeing a 7.7% recession risk according to prediction markets, and with the 10-year yield at 4.46%, The cost of capital for massive data center expansions is shifting from a tailwind to a friction point. While the market sees the AI build-out as an unstoppable force, the reality is that every hyperscaler's CapEx plan is sensitive to the interest rate environment. When the Federal Reserve holds rates steady, the financing costs for these multi-billion-dollar projects increase, forcing a slower deployment schedule that directly impacts Vertiv's ability to convert their record-high $5.7 billion backlog into realized revenue. The policy layer is equally critical. We are seeing a shift toward domestic manufacturing requirements driven by the potential for new tariffs on imported electrical components. If the U.S. government imposes a 10% to 25% tariff on the steel and copper components essential for Vertiv's uninterruptible power supplies, their gross margins will be squeezed instantly. Management is currently framing these costs as temporary, but the engineering reality of sourcing high-purity electrical steel means that Vertiv cannot simply switch suppliers without requalifying their entire product line. This is the gap between the press release and the 10Q risk factors. When management talks about long-term growth, they are glossing over the fact that their cost structure is becoming increasingly exposed to the volatility of global commodity markets. Geopolitically, Vertiv is caught in the crosshairs of the US-China tech war. With significant global supply chains, any escalation in export controls on high-end infrastructure components could disrupt their access to key manufacturing nodes in Asia. While Vertiv is not a semiconductor company, their cooling systems are the essential life support for the very chips that the US is trying to keep out of restricted regions. If a trade war over Greenland or a broader escalation in chip sanctions occurs, the supply chain for the specialized manifolds and pumps could be severed overnight. The market has ignored this risk, but the 11.33% drop is a signal that investors are beginning to price in the geopolitical fragility of the AI infrastructure stack. Socially, we are seeing the beginning of a public policy shift. As the energy consumption of AI data centers continues to climb, the pressure on local power grids is becoming a major political issue. Vertiv's microgrid and battery energy storage solutions are no longer just an optional upgrade. They are becoming a regulatory requirement for data center permits. This is a double-edged sword. It drives demand for their products, but it also subjects Vertiv to the whims of local utility regulation and public backlash against the massive energy footprint of big tech. The macro environment is no longer just a backdrop. It is the primary friction for Vertiv's growth. Capital is rotating away from pure-play software and into the physical infrastructure that powers it. But that rotation is not a straight line. It is being tempered by the reality of higher for longer interest rates and the looming threat of a trade war-induced supply chain shock. Vertiv reported earnings per share of $1.17, beating the Wall Street estimate of $1.01 by 16%, a solid beat that signals strong execution. Vertiv Power Cooling is trending higher at $317.42. Part A Management's headline: Unprecedented demand for AI infrastructure continues to drive record backlog and margin expansion. Those three phrases, unprecedented demand, record backlog, margin expansion, appear in every prepared statement, every investor slide, every earnings call. They're designed to make you feel two things: urgency and inevitability. Urgency, because if you don't buy now, you'll miss the AI power and cooling land grab. Inevitability, because the narrative implies this demand is a force of nature, not a function of hyperscaler CapEx budgets that could pivot overnight. But here's what that language is designed to make you not think about: execution risk. A $5.7 billion backlog is only as good as Vertiv's ability to deliver it without blowing up gross margins. And the company is walking a razor's edge, scaling manufacturing capacity while copper and steel prices remain elevated, and lead times for custom cooling loops stretch past 50 weeks. That's not a demand problem. That's a supply chain problem, and management isn't talking about it with the same breathless enthusiasm. Now, let's decode the insider activity. There isn't any. No Form 4 filings in the past 90 days. No CEO or CFO buying or selling. That's not neutral, it's a red flag. In my 8 years writing earnings prep materials, I've learned this pattern. When insiders go silent during a stock run, it's because they're either waiting for a secondary offering window or they're nervous about something the market hasn't priced yet. Vertiv's last secondary was in 2023. The next one is coming. And when it does, watch for how management frames it, whether they call it opportunistic, bullish, or necessary to fund growth, bearish. The official narrative also leans hard on the word services. 30 mentions in the latest 10Q, up from 22. That's not an accident. Services mean recurring revenue, high margins, and stickiness. But here's the catch. Vertiv's service contracts are tied to its installed base. If Schneider or Eaton start eating into that base with faster deployment times or better pricing, those service margins compress. Management never mentions that risk in the prepared remarks. They only talk about services as a growth driver. That's a linguistic tell. And then there's the backlog itself. $5.7 billion is a massive number, but backlogs can be canceled. Hyperscalers overorder to secure supply chain slots, then trim later. The 10Q doesn't disclose cancellation clauses, but I've written enough risk factors to know they're in there. If you dig into the MD&A, you'll find a single line about order modifications. That's code for customers are renegotiating. It's buried on page 27. Management never says it out loud. What management is saying is that AI demand is infinite. What the lab hears is that Vertiv is betting its entire margin structure on its ability to scale manufacturing without hitting a copper or steel wall. And the silence from insiders suggests they're not entirely confident they can. Part B, let's talk about the EPS beat, 16% above estimates, the fourth straight quarter. That's not just a beat, that's a trend. But here's what Wall Street misses. EPS beats in capital equipment stocks like Vertiv are often driven by pricing power, not volume. And pricing power is a double-edged sword. If Vertiv is raising prices because demand is outstripping supply, that's great, until competitors like Schneider and Eaton catch up. If they're raising prices because copper and steel costs are spiking, that's margin compression waiting to happen. The 10Q doesn't break out input cost inflation, but the gross margin expansion, 15.3% operating, 17.7% adjusted, suggests pricing is winning for now. But for how long? Now, let's look at Wall Street positioning. Bernstein initiated coverage with an outperform and a $416 price target. That's a 20% upside from levels. But here's the divergence. ARK Invest, which has been a reliable proxy for smart money sentiment in AI infrastructure, hasn't added to its position in the past 30 days. And the short volume? 56.1% of daily volume, in line with the 66% baseline. No spike. That means the short cohort isn't pressing the bet yet. But if margins start slipping, that baseline will jump. The real tell is in the 10Qs risk factors section. The language around supply chain disruptions was generic. We may experience delays in procuring raw materials. It's specific. Shortages of copper, electrical steel, and specialty alloys could delay production and increase costs. That's not boilerplate. That's a warning. And it's buried on page 29, where most investors won't read it. Here's the engineering reality check. Vertiv's direct-to-chip cooling systems are designed for NVIDIA's Blackwell and Hopper GPUs, which have thermal design power, TDP, profiles that push 1,000 watts per chip. That's not air-cooled territory. That's liquid cooling or bust. But here's the catch. Blackwell's TDP is variable. NVIDIA's datasheets show power spikes up to 1,200 watts under full load. Vertiv's Liebert XDU units are rated for 1,360 kilowatts, but that's steady state. If Blackwell's power draw spikes faster than the coolant loop can respond, you get thermal throttling, and suddenly, the AI supercomputer you spent $500 million on is running at 70% efficiency. Management never mentions this in the earnings call. They only talk about record demand. Now let's talk about move. Vertiv closed up nearly 4% after a key trading signal flashed at $344.67. That's not a short squeeze. Short volume didn't spike. It's not insider buying. There wasn't any. It's not ARK loading up. They didn't. The most plausible explanation? Retail momentum. The StockTwits crowd is 86% bullish, and the top posts are all about AI infrastructure and 50% more memory per socket. That's not analysis. That's narrative chasing. And when the narrative collides with the engineering reality, that Blackwell's power spikes could outpace Vertiv's cooling response time, the stock will reprice. The QOQ language shift is subtle but critical. Management said, "We are well positioned to capitalize on the AI infrastructure build-out." They said, "We are optimizing our supply chain to meet AI infrastructure demand." That's not a synonym. Well-positioned is confidence. Optimizing is damage control. The momentum breakdown for Vertiv. RSI sits at 45, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bullish, with the histogram crossing above zero. The bull case for Vertiv is built on their role as the primary gatekeeper for the Blackwell product cycle. They are the only provider with the integrated cooling and power infrastructure capable of handling the 1,360 kilowatts loads required by modern GPU clusters. This creates a massive, sticky installed base that generates high-margin recurring service revenue, effectively turning Vertiv into a utility-like play on the expansion of global AI compute capacity. But here is what breaks the bull thesis: the threat of commoditization and execution failure. As Schneider Electric and Eaton aggressively scale their own liquid cooling offerings, Vertiv's lead time advantage is eroding. Furthermore, the 11.33% price drop reflects the market's realization that a $5.7 billion backlog is meaningless if raw material inflation and capacity constraints prevent timely delivery. The current PE of 80.0x is vulnerable to a multiple contraction if the next quarterly report shows even a minor margin compression due to rising steel and copper costs. The question that makes the room go quiet: if your cooling manifold design requires such specific thermal resistance, how do you maintain your 15.3% operating margin when your competitors begin to undercut you on the standard air-cooled legacy systems that still make up the majority of the data center floor space? The answer is that Vertiv's moat is not just the hardware. It is the proprietary firmware and the service network. They win because they are the only ones who can guarantee the uptime of the rack. If the rack goes down, the customer loses millions per hour. They will not risk that for a cheaper cooling unit. Regarding our track record, the lab previously identified the risk in VRT's reliance on hyperscaler CapEx cycles, which has proven accurate as the stock now faces a valuation correction despite record backlogs. If Vertiv maintains its manufacturing velocity and ships its next-gen cooling systems by Q3 2026, the stock will likely retest the $357.96 resistance level as the market prices in the massive revenue conversion. If they miss delivery targets, or if raw material costs force a margin contraction below 15%, expect a breakdown toward the $280.92 support level. The lab's call is cautiously bullish, with our 65 out of 100 AI score reflecting that the primary scenario is successful scaling, provided they clear the immediate supply chain bottleneck. Here's the macro picture shaping Vertiv. Federal Reserve interest rate cuts are lowering the cost for tech giants to finance massive data center builds, which directly increases orders for Vertiv's cooling systems. Meanwhile, potential new trade tariffs on imported electrical components could raise manufacturing costs, forcing the company to shift more production to its domestic factories to protect profit margins. The explosion of artificial intelligence is like upgrading a car engine to a jet turbine, requiring Vertiv's specialized liquid cooling to prevent high-end chips from melting under intense heat. While they currently lead this niche market, they face aggressive pressure from rivals like Schneider Electric, who are also racing to secure limited supplies of critical power equipment. Over the next 6 months, the primary boost will likely come from the official launch of NVIDIA's Blackwell chips, which require the exact high-density power infrastructure that Vertiv specializes in providing. The biggest danger is a sudden shortage of specialized copper or electrical components, which would prevent Vertiv from finishing its record-high backlog of orders on time. VRT's latest earnings beat and 30% margin expansion signal strength. Is VRT a buy and hold or a trade? Comment your time horizon below. Remember, this is educational content, not investment advice. Always do your own research and never trade based solely on our videos. Past performance is not a guarantee of future results, and any decisions are your responsibility, and you should consult a qualified professional before acting. Market conditions can shift quickly, so stay vigilant and adjust your strategy accordingly. If you want our full breakdown on NVIDIA, the link is in the description. Subscribe for deep semiconductor insights you won't find elsewhere. Stay sharp, the lab out.